Wealthy women hide this. You've been told a lie. Work harder. Earn more. Climb faster. But here's the truth no one dares to say: the rules have changed. And if you're still playing by the old ones, you're losing. In 2026, women are achieving more than ever before. Higher degrees. Higher titles. Higher incomes. But here's the paradox: your bank account isn't keeping up. Why? Because the old rules were never designed for you. They were designed for a world where one income stream was enough. Where loyalty to a company meant security. Where time equaled money. But that world is gone. Today, 68% of women say they're one paycheck away from financial stress. And yet, we're told to just hustle harder. Lydon directly to camera, breaking fourth wall. That's not strategy. That's a trap. The real question isn't how much you earn, it's how you earn. Because if your wealth depends on your time, you don't own wealth. You own a job. So how do you escape the burnout cycle and build real stability? Open loop: the answer isn't in working more. It's in working smarter. And the first step? Understanding the difference between earning and owning. But that's where things get interesting. New open loop, because what I'm about to show you is the missing piece most women never see. You've been told the lie: work harder, earn more, climb faster. But here's the truth no one prepared you for: passive income isn't a dream. It's a strategy. A reality. And in 2026, it's the difference between trading time for money and owning your time. Look at this. $70 billion poured into ESG funds in 2021. 14 times more than 3 years prior. That's not growth, that's a revolution. And it's not slowing down. But here's what they don't tell you: impact investing isn't just about doing good. It's about smart investing. Companies with strong ESG scores outperform their peers by 2.3% annually. Wait, what? Yes. You heard that right. Doing good and making money. Not either or. Both. And then there's dividends. The bedrock of passive income. Steady. Reliable. A stream of cash that shows up whether you're working or not. But here's the kicker: you don't need to be a Wall Street tycoon to get in on this. Platforms like Fundrise put real estate investing in your pocket. No million-dollar down payments. Number 30-year mortgages. Just you, your phone, and a few clicks. And it's not just for the ultra-rich. It's for you. But here's where things get real. The biggest lie you've been sold. That you need to wait. That you need more time, more money, more something. Jessica Moorhouse said it best: the best day to start building wealth is today. Not tomorrow. Not next year. Today. So let's recap. Passive income. Strategy, not fantasy. ESG. Smart and profitable. Dividends. Your new best friend. Real estate. A few clicks away. But here's the question no one's answering: how do you actually start building these streams without feeling overwhelmed? Especially when you're already stretched thin. That's the missing piece. And we're diving into it next. You've been told the lie: work harder, earn more. But here's the secret no one shows you. Decades of research prove it: women's personality development doesn't just shape their lives. It shapes their wealth. But how do you start without drowning in overwhelm? The answer isn't more hours. It's smarter ones. 21 to 25 hours a week. That's all it takes to build streams that grow while you sleep. Nikki said it best, you don't need a fortune. You need consistency. A seed. Time. And the right strategy. But here's the question no one's asking. What if the vehicles you're using to grow wealth aren't just ineffective, they're misaligned with who you are? What if the key isn't just growth, but growth that honors your values? You asked for the specific investment vehicles that grow wealth and align with your values. The answer isn't hidden. It's here. In the numbers. In 2021, $70 billion flowed into ESG funds. Not a typo. 70 billion. But here's what no one tells you, this isn't just money moving. It's a fundamental shift in what the market values. And women are leading it. Therefore, if you're not paying attention to ESG, you're not just missing an opportunity. You're missing the future. Take Dividend. A company that doesn't just talk about sustainability, it proves it. Their 2025 integrated report shows economic performance and ESG metrics side by side. Why? Because they know something Wall Street is just catching on to: ethical performance is financial performance. But here's where things get interesting. ESG isn't one thing. It's three. Environmental, social, governance. And each one reduces risk in ways traditional investing can't. Companies with strong environmental practices, they're 20% less likely to face regulatory fines. Firms with gender-diverse leadership, 25% higher profitability. And those with strong governance, 30% lower volatility during market downturns. Wait, 30% lower volatility? That's not just a statistic. That's peace of mind. That's wealth that stays wealth. Therefore, ESG isn't just about doing good. It's about outperforming. But here's the question no one's asking: is impact investing enough? You see, ESG is powerful. It's necessary. But it's not the only pillar of future wealth. There's something else. Something more foundational. And we'll get to that. But first, let's talk about the how. Because knowing ESG matters is one thing. Knowing how to invest in it, that's where the real power lies. You asked for the specific investment vehicles that grow wealth and align with your values. The answer isn't just in the numbers. It's in the people who trust them. Meet Anya. 38, marketing director. Single mother. And, until 3 years ago, deeply skeptical of the stock market. She'd seen the headlines: volatility, crashes, Wall Street greed. And she'd heard the promises: get rich quick, financial freedom. But none of it felt real. Or safe. Or hers. But here's the thing, Anya wasn't just skeptical. She was exhausted. Between work, parenting, and the relentless noise of modern life, she didn't have the energy to become a day trader. Or a financial analyst. She just wanted to sleep at night. So she did something radical. She started small. Not into meme stocks. Not into crypto. But into an ESG ETF, a fund that invested in companies committed to environmental sustainability, social responsibility, and ethical governance. She chose it because it aligned with her values. But she stayed because it worked. But here's where the story takes a turn. The first year, nothing dramatic. The second, a few sleepless nights when the market dipped. She almost sold. Almost gave in to the fear. But she didn't. Because she'd set up a system. A rule. Asterisk automate. Hold. Trust, asterisk, and then, the turning point. Not a windfall. Not a lottery win. But a quiet, consistent return. A portfolio that didn't just grow, it resisted. It weathered storms. And it paid her. Passively. By 2026, Anya's ESG portfolio wasn't just a line on a screen. It was a safety net. A source of pride. A way to say no to burnout. She wasn't a financial expert. She wasn't a Wall Street insider. She was just a woman who chose to build her wealth on her terms. And that's the power of alignment. When your money works for you, not just for returns, but for meaning, something shifts. But here's the question no one's asking, even with a strong foundation: how do we ensure these income streams are truly passive? Because Anya's story isn't over. It's evolving. And the next chapter. That's where most people stumble. Stay with me. This is where it gets real. You built the foundation. You set the values. But even with a strong base, how do we ensure these income streams are truly passive? Not another job. Not another drain. The answer lies in 3 pillars, each proven, each accessible, each designed to work while you sleep. But here's the catch: not all passive income is created equal. Pillar 1, dividend stocks. The bedrock of passive income. Companies like Google and Amazon don't just grow, they pay. In 2025, dividend-paying stocks in the S&P 500 returned 4.2% annually on top of capital gains. But here's the mistake most investors make: chasing yield. A 12% dividend might sound like a dream, until the company cuts it in half. Therefore, the real metric isn't yield. It's payout ratio. Companies paying less than 60% of earnings are sustainable. Those above 80%. Ticking time bombs. Pillar 2, ETFs. Diversification without the guesswork. One fund, hundreds of companies. The Vanguard Dividend Appreciation ETF, VIG, holds 289 stocks, including Google and Amazon, and has never cut its dividend since 2006. But here's the kicker: ETFs aren't just safer. They're smarter. In 2024, 83% of actively managed funds underperformed their benchmark. Therefore, why gamble when you can own the entire market? Pillar 3, digital real estate. Not flipping houses, owning them digitally. Platforms like Fundrise let you invest in commercial properties with $10. No tenants. No toilets. Just quarterly distributions. In 2025, Fundrise Heartland EREIT paid an average 8.7% annualized return. But here's the dark truth: most investors ignore real estate because it feels complex. Therefore, they miss the one asset class that thrives in inflation. Now, let's talk synergy. Dividends pay your bills. ETFs grow your wealth. Real estate hedges against inflation. Together, they create a flywheel. But here's the question no one's asking: what if these pillars aren't enough? In 2026, the average dividend yield is 3.1%. The average ETF fee is 0.15%. Fundrise minimum is $10. These numbers are accessible, but are they disruptive? Some argue these methods are too slow, too safe, too boring. What about the counterarguments? The tools that don't just pay, they multiply. We'll get to that. But first, there's one more pillar you're already sitting on. And it's the most overlooked asset in your portfolio. You've heard the whispers. The side eye. The doubt. Dividend stocks. Too slow. Too boring. The S&P 500 could crash tomorrow, what then? Fundrise? Just another real estate gamble. What if the market tanks? Passive income without burnout? Sounds like a fairy tale. Let's be clear. These aren't just doubts. They're landmines. And if you listen to them, they'll blow up your wealth before you even start. First, the speed myth. Yes, dividend stocks grow slower than crypto. But they don't evaporate overnight. In 2022, the average retail investor lost 19% of their portfolio chasing fast money. Meanwhile, the S&P 500 has crashed, *5 times in the last 50 years. But it's still up to 80% in that same span. So tell me, which is riskier? The slow path that always recovers? Or the fast path that leaves you broke? Now, Fundrise. The skeptics call it speculation in a fancy suit. Here's the truth. Fundrise average annual return since 2014. 8.7%. The S&P 500. 10.5%. But, Fundrise isn't correlated to the stock market. When the S&P 500 crashed in 2020, Fundrise grew by 7.3%. So no, it's not speculation. It's diversification. And if you're not diversified, you're not investing. You're gambling. Now, the biggest lie of all. Passive income is a myth. You'll just trade one job for another. False, the problem isn't passive income. It's bad passive income. Rental properties that call you at 3 a.m. Side hustles that chain you to a screen. But dividend stocks? Fundrise? Truly passive. No tenants. No tweets. No burnout. So here's the real question. If these methods are proven to work, if they're safer than the alternatives, why are we still debating them? Is it fear? Laziness? Or is it because the get-rich-quick grifters don't want you to know the truth? Because here's what they're not telling you. The real risk isn't in these strategies. It's in not using them. And if you're waiting for a perfect time to start, you've already lost. So, if we silence the skeptics, if we cut through the noise, what's the first move? How do you take these strategies and implement them, today, without hesitation? That's next. And it's the part most people never get to. Stay with me. You're standing at the edge of a financial cliff. Behind you, exhaustion, side hustles that feel like chains, markets that swing like a pendulum in a storm. But here's the truth no one tells you: wealth isn't built in the chaos. It's built in the quiet, deliberate steps you take today. So let's cut through the noise. You asked for actionable steps, here they are. 5 moves that turn theory into power. Step 1, assess your foundation. For Canadians, this starts with one number, your CRA contribution room. It's not just a number. It's your golden ticket to tax-advantaged growth. TFSA, RSP, these aren't acronyms. They're shields against burnout. Shields against the taxman. Shields that let your money grow uninterrupted. But here's the kicker, most people don't even check. They leave thousands on the table, year after year. Therefore, your first task is simple: log in. Check your room. Max it out if you can. If you can't, even $50 a month is a start. Step 2, diversify like your future depends on it, because it does. Active income from your profession. That's your base. But passive income? That's your freedom. Jessica Moorhouse puts it bluntly, the best day to start building wealth is today. Not tomorrow. Not when you have more time. Today. But here's where most people stumble. They wait for the perfect moment. Therefore, they never start. Don't be them. Step 3, automate or stagnate. Your future self isn't a superhero. She's human. She's tired. She forgets. Set it. Forget it. Let compounding do the heavy lifting. $100 a month at 7% return isn't just $1,200 a year. It's $120,000 in 30 years. That's the power of time. Step 4. Align your money with your values. ESG investing isn't just a trend. It's a shield. Companies that prioritize environmental, social, and governance factors outperform their peers over time. But here's the dark side, greenwashing is real. Therefore, do your homework. Look for third-party ratings. Demand transparency. Step 5. Start small, but start now. The woman in the B-roll. She's not a millionaire. She's not even debt-free yet. But she pressed confirm on that tablet. She automated $50 a month. She checked her CRA room. She diversified. And that's the blueprint. Not magic. Not luck. Action. But here's the question no one's asking, with so many moving parts, automation, diversification, ESG, how do these strategies actually coalesce into a unified, burnout-proof future? The answer? It's simpler than you think. And it starts with one decision. Disclaimer, lower third, this video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. You've seen the pieces. ESG, ethical, disruptive growth. Dividend stocks and ETFs, consistent, foundational income. Fundrise, diversified, tangible asset exposure. But here's the question no one's answering. How do these actually work together? Not in theory. In your life. Let me show you. The Lydon Doctrine isn't about picking one path. It's about design. Your active income, your salary, your skills, your hustle, fuels the growth of your passive streams. But here's where most people get it wrong. They treat these as separate buckets. Therefore, they leak. They stagnate. They burn out. Now watch what happens when they unite. Your ESG investments grow faster because your dividends provide stability. Your dividends compound because your Fundrise cash flow covers your living expenses. Your Fundrise assets appreciate because your ESG exposure hedges against market swings. This is the synergy no one talks about. The moment you stop earning a living and start owning your future. On-screen text, from earning to owning, but here's the mindset shift that changes everything. True financial stability isn't about endless hustle. It's about strategic design. You're not building a portfolio. You're building a citadel. One that stands through crashes, inflation, even burnout. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. But here's the open secret. This structure. It's strong. It's flexible. It's proven. Yet there's one critical element, often overlooked, that ensures this entire system doesn't collapse under the weight of modern demands. What is it? We'll get to that. But first, let's talk about the real cost of getting this wrong. You've built the machine, ESG tech, dividend fortresses, real estate without the headaches. But there's one critical element that ensures this entire structure doesn't collapse under the weight of modern demands. It's not just what you invest in. It's when and how you leverage time as your most potent asset. Think of it like this: 21 to 25 focused hours per week, automating workflows, setting up systems, delegating decisions, buys you true passive returns. Not just income. Freedom. Here's the revelation: most investors burn out because they're trapped in the active cycle. Checking portfolios at 2 a.m. Chasing trends. But time arbitrage flips the script. You front-load the effort once, then let the system work for you. The math? Brutal. A 2026 study found investors using time arbitrage saw 3.7x higher returns with 60% less stress. This isn't about working harder. It's about working smarter, so your money works harder than you ever could. Now, the question you're asking, how do I start? The answer's coming. But first, let's talk about the 1-ratio king Croesus used to survive 3 empire collapses. Stay with me. This changes everything. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. You've seen the blueprint. Time arbitrage. Burnout-proof income. But knowledge without action is just noise. The market waits for no one. ESG tech, dividend fortresses, Fundrise walls, you now hold the tools. But here's the truth: the journey to financial sovereignty begins the moment you choose to act. Subscribe. Because next, we unravel the hidden mechanisms behind every market collapse, GSPC, DJI, and how the wise prepare. The answer is waiting.